Hey everybody, Marty Missouri here. Good morning. It's the 18th of December 2024. I thought I'd just pop in midweek with what I'm going to try to keep is a very brief video. Don't have a lot of new stuff to talk about. I want to re-emphasize what I talked about in the last video. Maybe run through some of our most recent internal notes and just kind of let you know kind of what we're thinking about the current and the go forward a little bit anyway. We've issued parts 1 and 2 of our year-end letter. I actually think we can do it all in 3 parts. I'm going to be working on that a lot over the next few days. May shoot another quick video over the weekend. You know, we have the Fed meeting this afternoon. Thought about waiting till this afternoon, but I don't think I'm going to have a chance to do this after the Fed meeting. But I want to talk about what our expectations are for that meeting today and what the potential ramifications for the market would be. Now, granted, when I talk about today's Fed meeting, and I'm going to reemphasize how bad the breadth is right now, sounds like I'm talking about, the immediate term and what the market's going to do in the short run. And in fact, I am more or less. I do like clients to have near-term expectations based on where we see probabilities so that they can see movements in their portfolio and put those into their proper context. But just know that the real deep work we do is, more fundamental, more long-term, and the goal is to have the right long-term asset class and regional, etc., diversification to weather, what we think odds favor going forward, or to put another way, when we think odds are becoming more favorable across certain asset classes, to really exploit that favorability, but to do it all within the proper risk-reward perspective or context, however I should say that. But, right now I know people are glued to the news, glued to the stock market, and I can't reiterate enough to you clients that we don't view the stock market as where we live necessarily, meaning there is a plethora of investable assets out there and asset classes. And to do this right, we need to think of the world, we need to think of things from a macro perspective, we need to think of the flow of capital, the movement of currencies, and we need to think other than just what the Dow Jones Industrial Average is doing on a day-to-day basis, for example. So speaking of the stock market, this is a good segue. So on the screen in front of you is some short-term stuff. So this is just today. And this is the IMAP screen in Bloomberg, which basically takes you, in this case, to the S&P 500. And you can see that right now it's up about 0.25% so far on the morning. Thing is, and this speaks to what we've been seeing dramatically the last few weeks, is that only, call it 50%, only half of the stocks in the index are actually up. And of course, it's technology, 62% of those are up. Healthcare is actually having a good day. That's good because that's a decent sized position for us. Financials and so forth. But industrials, we've got more down than up, and the sector is actually flat on the day. And the same thing for materials, consumer staples, utilities, real estate, and energy. So even though the market's up, half the stocks, or the market in this case being the S&P 500, half of them are actually down on the morning. In terms of the Dow, it's up a nice, it was up as much as a couple hundred points earlier today. It's up about 140, 150 points right now. Interestingly, breadth has actually gotten a little better. When it was up 200 points, only half of the Dow stocks were in the positive. Now it's 17 total are in the positive. Of the S&P, pretty much even. Well, I just told you that, even. As for the NASDAQ, actually pretty much even as well. Even number of up and down stocks. These are other indicators that, when it says MACD, that's one of the things that I feature in our technical analysis almost every time. There are buy and sell signals. We look at the MACD a little differently, but the textbook buy and sell signals, you can see that 43% of the Dow stocks are actually on a MACD technical sell signal, right? 27% of the S&P are in a sell signal. The NASDAQ 26% versus, you can see, very few that are showing a buy signal for what that's worth. Number of stocks are trading above their 50-day moving average, and I think I'll show you that screen again here. Just focusing on the S&P for a minute. While the S&P is markedly above its 50-day moving average, 62% of the stocks are below, meaning this 38% are the percent that's above the NASDAQ. 45% only are above their 50-day moving average, while the NASDAQ, is hitting all-time records, and so on. So breadth is really, really dismal right here. Doesn't mean that the market is going to come crashing down. A lot of people would say probably because of the correlation to periods where we've had such bad breadth. I would say, we've had a lot of bad breadth for quite some time. I keep illustrating it off and on the blog. And the market does seem to buckle when it gets really bad, but then it just seems to come roaring right back. Now, this is a dangerous period, folks, because that's what happens again toward the end of cycles. People get lulled into complacency. I heard quite the debate among BCA's analysts this morning. One was kind of implying what I'm more or less implying right here. The other one was their equity strategist, and she was very sanguine and made a lot of sense. She thinks this dip, yet again, if we do get it, will get bought. And it wouldn't surprise me if we get an early year dip, which wouldn't surprise me, by the way. It wouldn't surprise me to see that dip get bought. Ultimately, as we meander into this next year, we have some concerns that I've talked about already on the blog. In either direction, we have inflation and interest rate concerns if the economy continues to go higher or continues to expand. And if it doesn't, we have a market that is not remotely reflecting any chance of lower corporate earnings that come with recession. So that puts us kind of between that proverbial rock and a hard spot, hence the title of the last written blog post. So staying on breadth, the purple line is the NASDAQ 100 index just for the month of December. What a tremendous rally, okay? The yellow line is the exact same index, okay? All the same stocks. It's actually down 1.2% in a little less than 3 weeks. So this is a great rally. This is a painful decline. So how is it that the same index shows us different percent returns over a very short period of time? It's because this is equal weighted. This one is incredibly concentrated in Microsoft, your Teslas, NVIDIAs, that sort of thing. Although NVIDIA's been down lately, save for today. It's having a nice day. But as you can see, the index is relatively flat. The white is the S&P 500, which has a lot of that concentration as well, and it's basically flat for the month of December. The S&P 500 equal weight, this doesn't update today, but it is actually flat today, up 0.1%. The equal weight is down as much as the NASDAQ 100 is up. So again, this is the same, all the same stocks that are in this index. This just tells you that, folks, the stock market is actually down 4% if you equal weight it, which is just, what are stocks doing, on average for the month. You take out those top 10 and we're probably down 6-7% on the month. So if you're in a well-balanced, well-diversified portfolio, you might be wondering, how come I'm not enjoying this run? Well, it's because most of your stocks aren't up. Most of the stocks trading on the market are actually down on the month. Looking at the rest of the world along with the U.S., again, there's the S&P 500 index. MSCI Europe, Australia, and Far East index, it's actually down 0.4%. And here is the world index, ex the U.S., down 0.75%. Bonds are down, call it 3.5%. So again, that diversified portfolio, that 60-40, it has bonds, is having a rough year again this year because bonds have been a tough place to be. And the dollar, which we're going to spend a lot of time on in part 3 of our year-end message, is up 0.5% year to date. Again, just the illustration of that percent of stocks above the 50-day moving average. I showed you this last time. You can see the green line is the 50-day moving average for the S&P itself. Nice gap above that. That's bullish. This is very bearish. The most stocks are trading well below their 50-day moving average, and I've charted that for you here. When it's positive, when it's negative, tends to lead to, mid-single digit to massive declines before this plays itself out. Could be minor. There were some pretty ominous looking signs here, and we just had minor, 5, 6, 8% dips along the way. The NASDAQ composite one, I showed you this already. This is the scariest looking thing, and I've done a lot of work on this one. This just says, have some defensiveness in your portfolio. Massive concentration, and most of the stocks in the NASDAQ are actually declining, and the NASDAQ is hitting all-time highs. So the rest better start catching up, or the generals are probably going to roll over. The technicals, nothing really changed. Last time I showed you, we're dancing on this line on the daily chart. We still are. Expect some volatility around the Fed meeting. I'll talk about that in a second. The NASDAQ 100 hourly chart, kind of ambiguous. I was kind of looking to this to see what the market might be thinking about the Fed meeting today. Can't really glean much from that. The dollar, as I mentioned, continues to melt higher if we get that big flag pattern. As you can see this month, save for maybe for the NASDAQ, the dollar probably is providing a headwind. The thing about the dollar right here, though, is that we get to this high here. Technically, we're going to have quite the bearish divergence in momentum. That would be a bearish look. It wouldn't be a sell signal for the dollar, but it would suggest that there may be some weakness to come. That's not everybody's narrative, by the way. And then gold has been kind of a tough thing to own of late. I told you a few weeks ago we hedged it quite successfully. We rolled the hedge out yesterday or the day before. We took what was left of that hedge and rolled further out to March. So clients, we have a put about 6% below the money. Gold can be dramatic in terms of the volatility, and we have some concerns about the short-term outlook for gold. We are quite bullish on our long-term outlook for gold. So let's just quickly look at some of our notes. Peter Bookvar, one of my favorite economists out there, he talked about the retail sales. They rose 0.4% month on month, which was expected. This came out this week after a 1/10 decline in October. Not including in the core print was 2.6% jump in auto sales and parts, after going up about 2% in October. Building materials, also outside the core read, was up 0.4%. Elsewhere, spending was more mixed. It rose for furniture, electronics, sporting goods, and e-commerce, but fell for restaurants and bars, department stores, apparel, food, beverage, and miscellaneous, which includes dollar store, etc. For context, the top 20% income decile accounts for about 40% of all spending. Another interesting statistic is like the top 60% are doing 85% of the heavy lifting. He says here that the lower to middle income consumer has been much more circumspect. I would emphasize that. A lot of them are struggling mightily. It's that the folks who have higher incomes and the folks who own stocks, and I think I talked about this last time, or I did in the last written blog, U.S. consumers have more stocks in their net worth than they've ever had. I made a comment to a good friend yesterday who we were just kind of brainstorming, what ultimately would mess this thing up? What would create, economic weakness this next year? Now, that depends on the economist you talk to. I mean, two of the teams who we partner with or who we, spend a lot of time with and pay them for their expertise are on opposite sides of the spectrum there, and I shared a little bit of that with the last written blog. But I made the comment that, when you think about the incredible concentration in the stocks, not just concentrated in terms of the stocks that people own, but that fact that everybody owns stocks, and that these big spenders, are liking what their portfolio looks like. You get a break in the stock market, and you get that reflexive feedback loop, and you could see these people pulling back in if indeed their confidence around being able to spend money has anything to do with what they look at in terms of their net worth. If their net worth is substantially in stocks, and stocks take the inevitable hits they take from these levels, which typically aren't small. You could see that snowball into something that ripples through the rest of the economy and has impact, it has implications across the board. I'm not making that a forecast, folks. I'm just talking about the risks. Having done this 40 years and studied, 100 years of data, just know that it's not always going to be like this. With these multiples in terms of valuations, with this concentration, with the economy being artificially boosted for as long as it has, I'm not saying that 2025 is going to be a bad year. I think it's going to be a difficult year. I don't think it's going to be what a lot of people are anticipating it would be to the upside, but we want to be there to capture as much upside as we can, make no mistake. And we want to do it, though, as thoughtfully, smartly, and carefully as we possibly can. The yen is a position we have. The yen, I think, is going to be a very important position over the long run. Whether this year is the year or not, we shall see. There's a lot underneath that, more than just the fact that it's the cheapest it's been in 50 years, but that's something that we are very much focusing on or paying attention to. It's not a huge position, but it's going to be very interesting. Talks about why in terms of interest rate differentials and so forth. A little bit on China. China is the second largest economy on the planet, so we need to pay close attention to it. Discontent providers, right? Interesting take. This is from the Economist magazine. Economic protests, right? We learned around COVID that President Xi does take these protests seriously, and we are noticing it very much so in the language of the promises of stimulus going forward. So China is going to be very interesting to keep an eye on going forward. China may deliver the biggest rate cuts in a decade, hence what I just said. Financial conditions are the easiest they've been. Easy financial conditions, all things equal, tend to be pretty positive for equity markets. Back to the U.S., the ratio, let's call it, between growth stocks and value stocks, when you look at it in terms of valuing value stocks, they are the cheapest they've been relative to growth in 40 years, and growth is where everybody is concentrated. He just does it on a log scale here. And then I think I'll stop here. This one here is more the same, but right here, this is just a note internally to staff. I said, here you go. The Fed whisperer says hawkish cut. This is the guy the Fed asks to pin a story so that what they do isn't a total shocker to the market, i.e. the Fed's cutting by 25 basis points, that's today, but going to sound hawkish, i.e. they're going to set the market up for less cuts expected going forward, which could do, I emphasize could, a number on the market. There's massive options expiration this Friday, quadruple witching, which the experts tell us is probably net bullish based on what they've seen in terms of flows, and then they're talking about seasonality, although they're less bullish than they were 3 weeks ago. The market gets dicey this week, potentially, and likely ugly as early as this coming January if the Fed does turn hawkish today. So folks, I'm not, making necessarily any predictions, just talking about odds, still short-term stuff. Ugly markets are opportunities. You just don't necessarily like it on your statement. Again, we're not heavily exposed to an ugly market, but we want to be able to exploit it if the things that we think make good long-term sense get uglier. So this is nothing to be afraid of. These are things to look forward to. I'm going to stop rambling right there. Folks, thank you so much for watching and listening, and I will be back a lot, I guarantee you, over the coming weeks. Take care. Bye-bye.